Welcome to the Global Corporate Venture and Symposium. My name's James Mawson, founder and CEO of Global Corporate Venture and its sister publications. And it's a great pleasure to be able to introduce and interview Sir Martin Sorrell, the senior monk at S4 Capital. Welcome, Sir Martin.
Hello, Jim. Welcome on a Saturday morning from the monastery.
Well, it definitely feels like that. In reality, I think you're better described as the founder and executive chairman of S4 Capital, which is effectively your third iteration of the company. You were the group finance director at such a mainstream advertising company. You were the CEO of WPP, which when you were running it was the world's largest advertising company and media company. And now you're obviously doing S4 Capital, which is kind of taking things onto a new iteration. So how do you do the speed of execution?
Well, we've gone quickly, and that with it brings challenges, as you've seen in recent months. But we've really focused on trying to build a new model. It's highly disruptive what we're doing, and therefore it's somewhat difficult sometimes for people to accept the scale and speed of what we're doing or the changes we're bringing about. But our mission, quite frankly, Jim, was to build a new advertising and marketing services model and inevitably disrupt the old. We thought the analog model was not fit for purpose in a 24/7 always on world. Easy to say, and it is difficult to move, as I found in my previous iterations, difficult to move an analog business quickly into the new world. Having said that, agility and speed of execution is absolutely critical. If you and I were having this conversation on January the 1st, as opposed to around May the 1st, or a little bit after May the 1st, we'd have had a totally different conversation. Since then, we've seen withdrawal of fiscal stimulus, interest rates rise. We've seen GDP growth forecasts fall. We've seen a war in Ukraine, or we continue to see a war in Ukraine. We've seen lockdowns in China. The pace of change has been absolutely huge, probably brought about by the growth in technology. I mean, the initial thrust in my previous careers has been around globalization. So that was very much the dominant force around the growth of Saatchi and Saatchi. And then WPP was about continuation of globalization, the beginning of the web and the move in technology. And what we're seeing now is the acceleration of technology and probably, if not deglobalization, certainly a lessening. Global growth rates are going to be slower. Globalization, the pace of it will lessen or maybe even go into reverse, as some suggest. And as a result, corporations are going to have to be much more selective about what they do. Big question mark over Central and Eastern Europe, given what's happened. Big question mark over China, particularly in relation to its attitude towards Taiwan. Big opportunities, perhaps now, bigger opportunities in North and South America, the Middle East and Africa, and other parts of Asia, places like Indonesia or Malaysia, India in particular. Maybe India is the reverse or the opposite of what's going to happen in China. So Vietnam would be another market. So the pace of change has quickened, and the agility required to deal with that pace of change has heightened as well.
That's really interesting. And certainly as you think about this sort of almost that deglobalization, what does it take? If I think about S4 Capital as a sort of data or digital driven company first, what does it take to kind of dominate a market which is potentially $1.4 trillion in terms of the areas of focus that you would look to? What would it take you to become the sort of world's largest company in that context?
Well, we're a small factor. I mean, you're right. Last year we did about $900 million in revenue, and market's looking for about 1.3 billion this year. And we have grown at a pace. I mean, 44% last year, 20% in the COVID year, just under 19.4 to be precise, and then 40 the year before. So we've grown at a strong pace, and that's the organic growth, excluding deals. Last year, for example, we doubled in size effectively, and the other half of our growth coming from inorganic or mergers, as we call them. So we've got a long way to go. And size for size's sake is not the key. We positioned ourselves in the growth markets, and I'm of an age, Jim, where it gets more difficult. And therefore, and I have less time ahead of me, obviously. But what we're focused on is where growth is. The formula behind S4 is really very simple. Going where the growth is. In my latter years at WPP, we struggled in terms of top line growth. In fact, there are sort of two buckets of companies. There are companies that I say look at the sky, which means grow aggressively and tend to be expansive. And then there are companies that look at their feet. It's the best way I can put it. It's a pretty inept way of putting it, but looking more at cost rather than revenue. And what we're there to do is to grow our clients' revenues, to increase the speed of organic growth. So we're in the areas, and there are three areas. The first being content around social and around search and around video, connected TV, etc. The second is around data and analytics and digital media. So dealing with the 6 big platforms, Google, Facebook, Amazon, Tencent, Alibaba, TikTok, all the others as well, Apple and Microsoft and Adobe and Oracle and Salesforce and IBM and SAP and Twitter and Snap and Pinterest and Spotify and Shopify and Netflix and Xiaomi and JD.com and all the others, Kaohsiung and all the others, LG and Samsung. So it's the platforms, the hardware companies and software companies understanding which way they're going. So that's the second bucket. And the third bucket is technology services and digital marketing transformation. And when you look at those areas, there are 3 functions inside corporations that we deal with: marketing, sales, and IT. And it's putting those 3 together. I mean, the CEO, when they're looking at digital marketing transformation, looks at those 3 areas. So historically, we've tended to focus more on the chief marketing officer, the chief sales officer. Now we're focusing equally on the CIO and the CTO, because there are those 3 elements of change that we see inside corporations in the path to digital transformation. What is really interesting is that when COVID hit in March and April of 2020, when we were all panicking as to whether the world was coming to an end, what was really interesting was the speedy realignment of companies. Change agents inside companies were immediately given more oxygen. And I think you're going to see that again as GDP growth. This year, it'll be around 3%. Beginning of the year, we thought it'd be 4 or 5. Last year, it was 5 to 6. Next year, it'll probably be about 1.5%, 2%. Everybody's worried about recession in certain parts of the world. In that environment, I think what you're going to see is a real speeding up. In fact, one of our people in our weekly management call this week heightened or focused on the opportunity in the second half of this year to drive digital transformation change through clients as their top line growth came under pressure.
Interesting. That's fascinating. And so how do you think the sort of S4 Capital structure helps? So if I look back at, the Such and Such days or even WPP, they were quite a sort of conglomerate structure, whereas obviously, S4 is primarily sort of employee owned. I think it's 39%.
Well, yeah. I mean, I argue that the WPP structure or the holding company structure was siloed. So you had competing brands. The original holding company structure stretches back 70 years to Marion Harper and IPG in the 1950s. So it's quite an old model, particularly when you think the companies usually last, I think, on the S&P 500 or in the FTSE 100 for about 13 years. I think McKinsey came out with that stat. It was either 13 or 11 years, something like that. So that there's tremendous churn in terms of leading companies because of that pace of geographical and technological change. But the structure was a very siloed one for competition. WPP, we had Procter inside Gray, we had Unilever inside JWT and Ogilvy, and we had Colgate inside Young and Rubicam. And you had to have separation, often because of conflict. Those conflict issues have blurred. They're still there, but not to the extent that they were in previous years. And as a result, a unitary structure is more acceptable. And S4's differentiation is around its unitary structure. One P&L, access for clients to everything we do. We have 8,500 people now in 33 countries. Access to those people, we would say instantly, that's an exaggeration, but certainly as effortlessly and seamlessly as possible, and not creating silos. And, you referred to acquisitions, or people refer to acquisitions. We don't refer to them as acquisitions, we refer to them as mergers. Firstly, the structure coming to employee ownership. managers own, we're an owner managed company. We're not a manager managed company. There's nothing wrong with manager managed companies. It's just that I think the motivation is much stronger with owner managed companies. 40% of the equity is owned by people who live and work inside the company. And the structure of deals that we do is always 50-50 in terms of cash and equity. So in other words, we say to owners, join us on our mission. There's something missionary about this. We're on a journey. We're really focused on creating that new model and disintermediating, disrupting the old. So there's a missionary zeal there. But we're saying it's perfectly respectable for you to capitalize on all your hard work and take out half for cash, but let the other half run in terms of equity. And so everything we've done to date, and we've done a fair bit. I mean, we had two core deals around Media Monks and around Mighty Hive. So around content and then data and analytics and digital media. We've added about a dozen companies to each around content and around data and analytics and digital media, and then fused the two into the operating brand Media Monks. And then we recently branched out into a third discipline around technology services to compete with Accenture, more effectively with Accenture, because we compete very heavily with them, with Globant, with Endava, with EPAV, with Perficient, with CNIT, with ThoughtWorks. These are all listed companies that operate in the technology services area. So we come at, as I said before, the CMOs and the CSOs and the CIOs and the CTOs. So that's the theory, but the structure is unitary, one P&L. We think the holding company problem is it's too fragmented. We know it very well because in part, not in wholly, but we created it. And we created the monster, and it's too siloed. And in today's 24/7 always on world, there are three things that really are important at the minute. Agility is one. Taking back control, if I can use that very effective tagline Dominic Cummings, Boris Johnson used in the Brexit campaign. Marketers have to take back control. But in the 24/7 world, they have to have much more ownership and control of what they do. And finally, there's a focus much more in a granular point on first-party data, given what Google has done on third-party cookies and Apple on IDFA. So mastering your first-party data, consented data from consumers to get over the privacy hurdle, using that consented data in an effective way is absolutely critical, and deploying that with the signals that you get from the platforms. So those are the areas that we're sort of focused on. It's a unitary model, and we're trying to create one company that works together effectively. It's not easy to do. We're dealing with entrepreneurs who are very proud of the brands that they built, but we've managed to align everybody around the Media Monks brand, and we continue to do that and build that over time.
Fascinating. I mean, the way I kind of think about it a little bit is it's almost like an effective, like a private equity, but listed shop.
Well, so our model is a private. We have a golden share. We're a standard listing because of that weird structure, where the owners have control, or the owner has control. That's a structure which is quite common in the US and common in fully listed companies, in NASDAQ and NYSE. Here in the UK, despite the Hill recommendations, we could convert our standard listing to a premium listing if I was prepared to give up the golden share after 5 years. At the moment, we're not prepared to do that. And I think it's a real issue for the UK markets. I mean, the UK markets, one investment banker came into my office a few months ago and said, how many companies listed in the UK in the FTSE 100 are in the top 100 liquid companies in the world? And the answer, amazingly, is none. Yeah. About 5 or 10 years ago, apparently, it was about 10 or 11 companies like Unilever or Shell or BP or whatever. But today, we have no listed companies that are in the top 100 most liquid companies. And valuation criteria are different in the US. In our sector, companies that, for example, are in the tech services sector, an area that we're increasingly penetrating, as you'll see in the coming weeks, that area is rated much more highly in the US than it is here. Even the holding company area, where we're valued at a premium to that, despite recent gyrations. Even in the holding company area, the US agencies are valued much more highly. I mean, Omnicom, which is the world's largest now by market cap, and Publicis, which is an IPG, which is the fourth largest, are valued more highly in terms of multiples than either Publicis or WPP. And if you look at the performance over the last 4 or 5 years since I've left, I think WPP has been the worst performer. I think Omnicom has been the third, Publicis the second. May actually be Publicis is the third and Omnicom the second, and IPG has been the first. So the top two performers have been the American-based companies, and I'm adjusting for dollar, for currencies in that analysis. So it's quite interesting. The US market, I think, because of its liquidity, because of its higher liquidity, as a result, I think gives better valuations. And in the tech sector, they seem more at ease with tech companies. I mean, there are two buckets of tech companies. There are tech companies that make money and have cash flow and margin, and those that don't. And of course, it's the latter category that has come in for heavier punishment recently. But you know, those in the first bucket as well have been punished, as we've seen, and in the correction that's taken place over the last few months.
Yeah, it's really interesting. Now, if I look more on the corporate venturing side, WPP seem to have a method of almost consolidating, you know, companies into its parent company without necessarily taking full control. Whereas with S4, you set up S4S Ventures, which is you and Daniel Pinto at Stanhope, and obviously sort of Sanya Partolo, who you used to work with at WPP. So how does S4S Ventures fit with S4 Capital, and what are you trying to look for? And is it kind of like outsourcing the CVC function to them?
Well, it's you know, we're in the services business, and we've said, you know, when we look at mergers, we look at, for top line growth, we look for EBITDA margins, strong EBITDA margins, 20% plus. We look for management ownership. I mean, we don't like PE dominated companies, that is companies where PE firms own 80, 90%. For example, we saw one company where loved the management, thought they were really outstanding, but they had less than 5% of the equity, and we're looking for sort of motivation, not just professionally, but financially too. So, and the fourth criterion is not susceptible to technological change. We don't wish to be disrupted by technological change. However, as we've grown and developed S4, what we've seen is our people understand technological shifts. For example, Epic Games, the Unreal Engine, which we've utilized far more aggressively and far more effectively, first mover advantage actually in that, in terms of deploying it to produce content around the world. So our studio in New Delhi, which we just built around the Unreal Engine, can produce commercial work, video commercial work, digital video commercial work anywhere in the world from New Delhi. Obviously, if we're going to use Brazilian actors, we'll have to have Brazilian actors in New Delhi, but we can actually do the shooting out of India. Phenomenal increase in technology. We deployed it very quickly. Metaverse is another thing. You work very closely with Facebook, with Meta on the development metaverse, with NVIDIA, with Roblox, and with others, and we've utilized the technology. So what our people are very good at is identifying the new trends, the new opportunities, the new technological developments, and applying them as a service company to our industry. So, you know, we don't bet on technology. We use technology in the best way. I described all those companies that we look at. We're trying to look at what their advantages and disadvantages are. So we didn't want to risk any capital from S4 Capital. So Daniel and Pinto and I at Stanhope sort of sat down and said, why don't we put together a fund? We're targeting about $150 million. We'll have the first close very, very soon. We'll be making our first investments very soon. Well, the first close will be around about $100 million. And that is capital that we raised from outside. Management is putting in capital as well, myself and other directors of S4 and others, but it's not S4's capital, and we don't want to risk any of that. S4 will be a general partner. and we'll have a share of the carry, which we will distribute to those people inside our company who come up with ideas that we deploy in S4S Ventures. Sanya has got a great track record at WPP of spotting the winners, and she worked with Scott Spirit and myself in that area. And she's got a fantastic background and a phenomenal woman who's managed to develop a fantastic career, having had some big challenges as a teenager, as a refugee really, and she's an outstanding woman, and she's going to build a portfolio. And the idea is to work on early stage, not right startup, not non-revenue generating operations, but operations maybe Series B or Series C or operations or fundings which we think have application to what we do, that we've identified and spotted, or others have identified and spotted as being relevant in the three areas that we operate in content, in data and analytics and digital media, and then in tech services. So that's the theory. It is corporate venturing, but in an associated vehicle with no risk capital from the services company, but deploying capital from others. So we think, we'll come up with some interesting thoughts. We already have done. The market is febrile. I would say that on valuations, what we've seen in the listed markets, the fall in valuations has not permeated the PE markets or VC markets yet.
Yeah.
But our view is it will do over the next 2 or 3 quarters, maybe by Q2 or Q3 of this year, when companies have started to market. I mean, I'm sort of on a fund which invested quite heavily in PE last year, and that fund was up 45%. I haven't seen the mark to market this year, but I assume it will be down 15 or 20%. So the net will be 25, 30 over the 18 months or so. But PE has had a tremendous run, as we know, raised a lot of money last year and has to deploy that money this year. So I think PE will continue to be. I think PE last year outpaced strategics, I think for the first time in terms of deals. So at the margin, more than 50% of M&A activity last year was done by strategics. You could argue, I often ask PE people, how much of the world economy do you own? And the answer that comes back is around sort of 15 to 20%. So overall, maybe 15 to 20%, but at the margin, it's 50% in terms of deals. So they're increasing their market share quite rapidly. And of course, the VC market, which is highly developed in the US, is now starting to develop in other areas of the world, including Europe. So it will be more competitive. But I think valuations will come down, Jim, and we're already starting to see it. It's taking the foot off the gas in terms of employment. So people in private companies who have options or are looking at IPOs are having to look at lower valuations and lower IPO pricing.
Yeah, I think it's spot on. I think our conservative assumption is it's going to take another 2 years, really, I think, for valuations to start to fall, because there'll probably be a bit of an overshoot, if you look at historical cycles. But, so it seems quite an interesting time to have a vehicle being set up with that sort of context. You could do it. It's almost, if I think about it, it's that sort of eyes and ears. You can see the different technologies in an early stage. And then could you imagine S4 acquiring some of these portfolio companies as well? How would you manage a conflict of interest?
We have to watch in terms of conflict of interest, I guess. I doubt it, because again, what we will be in S4S Ventures, we will be investing in technology. S4 Capital doesn't do that. It deploys technology. I mean, if I put it crudely, we're resellers of the platforms of the hardware companies and the software companies. And we spot, we do care who wins, because our clients, our biggest client is Alphabet or Google. Our second biggest client is a well-known telecoms company, which I'm not allowed to name for NDA, but you can guess who it is. Our third is Meta. So we want them all to win. Having said that, as new technologies develop, as Snap or Twitter or Pinterest or TikTok develop, we want to deploy those new platforms in the most effective way, as Adobe and Salesforce and Oracle and SAP and ServiceNow and everybody else deploy their software in in more effective ways. Microsoft, Apple with its hardware, LG or Samsung, whatever it happens to be, as they deploy, we have to utilize the hardware, software, and the platforms for our clients in the most effective way. So I doubt very much I doubt whether we will. And S4S Ventures will not invest in service firms, they'll invest in platforms. So often we get inbounds and we have outbound conversations on companies that are service companies. I had one in South America this week. Really interesting company, built a lovely position, but they're a platform. They sell the platform into the holding companies. The holding companies are a little bit naughty because they take the platform, they present it as being their own, and they basically just get a commission on top or a fee on top for deploying it with the client. The platform does the work and does the technology, and they claim sort of authorship and ownership, and the client doesn't really know who's providing the platform. So I doubt very much. Well, not I doubt. We probably will not, or definitely will not, acquire anything. But what we will do is work with the technology if we think it's in the interest of our clients to do so.
Feels like a great model there, Sir Martin. It feels like you've got
it's like
ideas to see the
it's like, you know, WPP, we did it directly, and we took, you're right, you know, we took minority interests, sometimes very successfully, sometimes not so successfully. So we had we had our ups and downs there. Generally, I think we did very well overall in terms of returns. But you know, having said that, here at S4, it's always 100%. On that 50-50 model. It's always the service model. S4S Ventures will take stakes, obviously. We'll take small stakes, minority stakes. We'll work with the management as best we can, try and provide knowledge from what we know and see, you know, on our client base and around the world. You know, we operate in 33 countries, so we see a lot, and then we can evaluate a lot. So we'll get our people to help in terms of evaluation.
Yeah, it feels like it. If you think about it from an entrepreneur's point of view, she wants capital, but she wants customers and suppliers as well as product development and hiring and exit. I mean, you're helping with that customer bit.
Yeah, really. It's interesting. I mean, when I think about when people get together with us, what are they looking for? Well, they're looking for access to talent, and we have 8,500 people in 33 countries. So digital talent, which is highly prized. They're looking for access to capital. Now, we don't have unlimited capital, but capital. They're looking for access to clients. We can't get to everybody, but we certainly can help. And they're looking to access to geography. You know, we're in North and South America, we're in EMEA, and we're in Asia Pacific. So they get those four areas of activity. You know, clients and countries and capital and people. Those four areas that they need for further development. Often the companies that we get together with have one location, and they might be US based, or they might be South American based or Asian based, and they're looking to expand their operations globally, and they get instant access.
Wonderful. Well, Sir Martin, it's been a great pleasure and honour. It's nice to see you back in the GCV Symposium. Obviously, it's been a few years since the last time, and a number of changes, but you haven't changed a bit in terms of the ideas and execution you're bringing. So thank you. It's been a great pleasure.
Thanks very much, Jim, and I hope everything goes well with GCV.